Markets just violently whipped gold and silver in both directions over the last couple of weeks. One moment they're ripping, the next they're dumping, and Friday tagged a pretty ugly low. The convenient explanation? A Fed chair storyline. Clean, simple, and very sellable. But I wasn't even planning to make this video. I was in the middle of normal life stuff, and then I watched the tape. And the question hit me hard. What are they trying to make you believe right now? Because whenever volatility spikes like this, the loudest voices rush in with the most convenient story. And if you're holding metals or thinking about getting involved, you deserve more than a headline explanation. So here it is. It's Monday, February 9th in New York. Before we go any further, comment what day and date you're watching from. Quick note, I'm actively working to shut down copycat channels. If you value this content, support it by subscribing and commenting. That's it. Simple. Now let's rewind one step, because here's what always happens in stretches like this. Markets don't just move price, they move attention. One day everyone feels like a genius because the chart is green. The next day everyone feels stupid because it's red. And somewhere in between, the only people consistently winning are the ones who can keep their brain from doing gymnastics. So when you see wild volatility, translate it properly. Liquidity is thin in certain areas. Leverage is being squeezed. Headlines are being used as steering wheels. And the market is testing where weak hands are parked. That's not a judgment, that's just mechanics. You can be smart and still get shaken out if your position size is wrong or your time horizon doesn't match your trade. And metals are especially good at messing with people because they don't behave like stocks. A stock's story changes. Earnings, products, scandals, management. Gold's story is ancient. Gold's story is trust. It doesn't need a new reason every week. It only needs the old reason to remain true. And that old reason isn't that gold is shiny. It's that paper promises have a long history of getting stretched. Here's a mental trick you can use in any market. Whenever price does something emotional, ask one question. Did reality change? Or did positioning change? Reality moves slowly. Positioning can flip in an afternoon. And over the last 2 weeks, what we've mostly seen is positioning behavior. Chasers got trapped. Forever holders suddenly discovered stop losses. The buy-the-dip crowd went quiet, and that quiet is usually when opportunity starts forming. Here's a clean framework to keep you sane. Gold is the macro barometer, silver is the amplifier. Gold tells you what the world thinks about money. Silver tells you how emotionally the world is reacting to that thought. If you keep those roles straight, everything gets easier. You stop expecting silver to behave politely. You stop expecting gold to trade like a meme coin. Over the last 2 weeks, everything has been shaking. Metals, stocks, crypto, even the stuff that's supposed to be boring. The trap is reacting emotionally to every headline. Because if you zoom out, the boring truth is this. Gold and silver are still winning the race on the scoreboard that actually matters. They're still ahead of the major US stock index so far this year, and last year showed a similar pattern. That doesn't mean it's easy. Silver especially has been acting like it drank 3 energy drinks and tried to drive a stick shift in a snowstorm. But if you judge your entire strategy based on one ugly candle, you're letting a single frame of a movie decide the ending. So here's what we're going to do. What actually happened during this pullback, beyond the popular explanation, what the market is quietly signaling underneath the noise, the realistic paths from here to new highs, including the uncomfortable ones. And yes, there's a specific silver issue coming up that could turn into a headline fast. And most people will misunderstand it when it hits. The mindset that matters. When people say metals are down, what they usually mean is metals are down from a recent peak I personally stared at. That's not analysis. That's emotion wearing a spreadsheet costume. A better question is, compared to what? Compared to cash sitting still while prices quietly rise? Compared to an alternative you almost bought? Compared to purchasing power you didn't protect? Cash doesn't scream when it loses value. It erodes politely, like a slow leak in a tire you don't notice until you're already on the highway. And when you view metals through that lens, pullbacks stop looking like betrayal and start looking like what bull markets do. They shake you to see if you'll drop it. Now ask yourself something honestly. If you didn't hold metals, what were you going to hold? Most people aren't choosing between gold and stocks. They're choosing between gold and doing nothing. And calm is not the same thing as safe. Safety is purchasing power. Safety is optionality. Safety is not being forced to sell because you ran out of runway. That's why metals keep finding buyers after pullbacks. Not because everyone turned into a gold bug overnight, but because people are trying to store effort. Money is stored effort. And when people feel that effort is being watered down, they look for containers that leak less, Gold leaks slowly, silver sloshes, but it can still work if you respect it. The dollar, the Fed, and the convenience story. Yes, the dollar matters. Yes, central bank messaging matters. But a dollar bounce is not a diagnosis. It's a mood swing. The dollar can rise for reasons that have nothing to do with long-term health, positioning, flows, fear, headlines. Saying, the dollar bounced so metals are done, is like saying, it rained today so summer is canceled. As for tough talk central bankers, let's be adults. The system carries a lot of debt. It rolls a lot of refinancing. It does not tolerate high real rates forever. That's why markets can price tough talk and future easing at the same time. It looks contradictory if you're new. It's normal if you've seen cycles. Yes, a headline about leadership changes may have acted like a match, but the gasoline was already on the floor. This was a crowded trade. Leverage was high. Tourist money piled in. The market didn't need a perfect reason to pull back, just a reason that sounded good on TV. The public story is always about a person. The real move is usually about positioning. What the charts are actually saying gold did something important. It dipped, bounced, and reclaimed a key behavioral reference, the 50-day moving average. Not because it's magic, but because strong trends tend to live above it. Buyers defended it. That doesn't mean gold can't retest lower. Markets love revisiting pain points. But so far, the damage looks more like a pullback within a larger trend than the start of a new bear market. Those long lower wicks matter. They show sellers tried and failed. If panic doesn't spread on day 2, a floor often forms. Zoom out to the weekly chart and gold is still operating inside a broader uptrend. If gold chops sideways into spring, that's not wasted time. That's digestion. Silver, the chaotic cousin. Silver is not gold's little brother. Silver is gold's chaotic cousin. It has two personalities, monetary and industrial, and that's why it overshoots in both directions. There's chatter about an upcoming delivery month and whether physical supply could get tight. Let's slow this down. Most futures contracts never take delivery. That's normal. The real question isn't total volume. It's the marginal ounce. The ounce that's available without causing stress. Silver can experience pipeline pinches even when global supply exists, because delivery is about logistics, incentives, and timing. Does this guarantee a moonshot? No. Does it deserve attention? Yes. Treat it as a risk factor, not a prophecy. Add in thin holiday liquidity and overseas demand cycles, and silver can get wild fast. That's why staged buying beats heroic buying. Silver can absolutely flush lower before it rips higher. That's what it does to punish overconfidence. If your position makes you check price every 5 minutes, it's too big. The real setup going forward. Gold's base case, consolidation, boredom, then another attempt higher. Silver's base case, volatility, healing, then potential acceleration later. Both paths can lead to new highs. They just feel different emotionally. And that's the real test. If you can watch a pullback without needing to act, you're ahead of most people. If you can add calmly when it feels uncomfortable, you're ahead of even more. If you can hold through boredom, you're rare. That's where real wins come from. The popular story says this move was about one headline. I think that's lazy. This was a crowded trade meeting, a liquidity event with a convenient narrative attached after the fact. That doesn't mean metals are dead. It means they're alive, and alive markets try to buck you off before they reward you. Stay sized right. Stay thoughtful. Don't let loud voices talk you out of a thesis you built for a reason. This is educational content, not financial advice. Do your own homework. Only take risks you can live with.